All right, so now we've covered the primary types of intermediaries that facilitate the flow of capital throughout the financial system. We now are going to turn our attention to the specific domain of the stock market. Okay, so our final set of learning outcomes here will address how individuals interact with the stock market. Specifically, we will describe the fundamental characteristics of the stock market and identify the strategies that investors employ, like active versus passive approaches. We'll also discuss the nature and the operation of the efficient market hypothesis, which is part of our traditional finance theory. And then we'll explain the significance of behavioral finance, which is a discipline that uses psychology to understand investor decisions. So a fundamental principle here of the financial world is that stock represents an ownership stake in a corporation. So when you purchase stock, you become a common shareholder, and each unit of ownership is called a share. Common stocks typically grant shareholders the right to vote on company issues. Furthermore, depending on the company's profitability, they may offer dividends, providing investors with some regular income in addition to the stock's market value. So how is that market price determined? Well, once a company's shares start trading on an exchange like the NASDAQ, the price is determined dynamically by the supply and demand for those shares in the market. If investors' demand is high because the company is expected to experience future growth, the share price is going to rise. But if the outlook is low or weak, sellers are going to push the price downward as they sell. So when participating in the stock market, investors consider several core strategies based on their goals and their risk profiles. Active investing means selecting individual investments with the explicit objective of beating the market. That is, achieving returns higher than the standard benchmark like the S&P 500. This often involves short-term trading based on market movements and data. In contrast, passive investing involves building wealth gradually over the long term, typically by participating in index funds that simply track the average performance of a major market index. The goal here is not to outperform the market, but just to match its returns reliably and cost-effectively. Separately, investment timing is critical. Market timing refers to making investment decisions by interpreting market conditions, company news, and data that's out there to help you predict the optimal time to buy and sell. Because successful market timing is notoriously difficult, many investors opt for dollar cost averaging. This practice involves consistently adding a fixed amount of money to your investments at regular intervals over a long period, regardless of whether the market is up or down. So while dollar cost averaging prevents you from consistently buying at the highest prices, it also prevents you from buying only at the absolute lowest prices. So it's a conservative risk offset strategy. The efficient market hypothesis, or EMH, is a cornerstone of mainstream finance theory. It addresses the fundamental question of how effectively security prices reflect a company's value. The EMH states that financial markets are inherently efficient because the prices of assets, including stocks, reflect all available information relevant to a company's value. It further assumes that all market participants possess this information equally. The profound implication of the EMH is that because stocks are always accurately priced based on known data, it is impossible to consistently beat the market on a risk-adjusted basis by trying to select undervalued securities or timing the market. The theory suggests that stock prices move randomly in response to new information, and therefore an investor seeking the best long-term results should employ a low-cost passive approach, such as buying a stock index mutual fund. The efficient market hypothesis rests on the core assumption that investors are perfectly rational actors, free from emotion. However, the field of behavioral finance challenges this whole view. Behavioral finance is the study of how human psychology affects investors and consequently the financial markets. This approach helps us to understand how investment decisions are influenced by human emotion, various cognitive biases, and psychological limitations in processing information. Behavioral finance asserts that investors sometimes lack self-control and they act irrationally, basing their decisions more on emotions than on facts. Proponents of this view maintain that these predictable, irrational behaviors create inefficiencies and mispricing in financial markets, contradicting the EMH's assertion that assets are always accurately valued. Sorry. Behavioral finance has identified several specific biases that lead investors away from rational decision making. For example, people often use mental shortcuts or heuristics, such as assuming that past investment success is a reliable indicator of future returns, which is often a mistake. Other prominent investment biases include loss aversion, which is this psychological tendency to focus more on avoiding a loss than on recognizing potential gains, sometimes causing desirable opportunities to be ignored. Herd behavior is another strong influence where people simply copy the financial decisions of the majority of investors, which can lead to dramatic, irrational market rallies or sell-offs. Furthermore, biases like overconfidence, the belief that one's personal knowledge or ability is superior, and acting based on an emotional gap, extreme feelings like anger or excitement, those can often override well-considered investment strategies, resulting in irrational outcomes. So, all of this stuff we're going to talk about in your economics course as well. I keep saying that because there is a bit of overlap here. But I hope this has been interesting for you. I hope you're enjoying these videos. I'm going to try to keep making these for you. And yeah, I'll see you all in the next one. Have a good one.